So the Fed just keeps going up until they see inflation start to come back down, or maybe the unemployment rate go up. But at that time, the market still goes down by another 25-30%. Now, I'm just talking about stock. Now, I think we could see the same thing in the housing market.
In today's Essential Investing Highlight, internet sensation and contrarian economist George Gammon reveals the historic data that proves trying to front-run the Fed pivot is financial suicide. Yet this is exactly what some, like Raoul Pal, are advocating. Make sure you watch until the end, because after that, George maps out exactly how the Fed is going to play the next 2 years step by step, so you will know how to profit from their stupidity.
I think this 2020s will look very similar to the 1940s. My good friend and I, my good friend Lynn Alden, and I have been saying this for, probably, it feels like 2 years now, that it's not really the 1970s, that it's probably going to be the 1940s, in which case you had 3 massive spikes of inflation. And you had some price control in there as well, which I think we'll see. Maybe we can talk about that in a moment. And in 1947, the CPI went up to 19.5%. And then less than 2 years later, it was -2. But then, of course, the government came in with more deficit spending for the Korean War, and we saw that inflation rate go right back up. So I think you're going to see something similar in the 2020s. Now, the way this might play out going into next year is we get some disinflation, like we were saying, because of the demand destruction with the housing market going down, with the stock market going down, which is a huge component of most people's purchasing power, especially in the United States. And then what we see is the government come in and most likely try to, quote unquote, stimulate the economy. I think the Fed will come in. Most people are putting a little bit too much weight, I believe, on the Fed put, because I think the Fed put has kind of expired to a certain degree. Where if you look at March of 2020, when we were in the depths of the collapse, really, that quick collapse that we had as a result of the government policies around COVID, or the fears of COVID back then. The Fed had a meeting set up for Wednesday, this particular Wednesday, and they actually had an emergency meeting on Sunday where they came out, they dropped rates. I believe it was from 1% down to 0. They announced basically QE infinity, and they committed up to $1 trillion a day in repo. And the market was down the next day by like 1,500 points. And the market continued to go down until the government came out with the CARES Act. So the government had to come out with fiscal, and that's when the market actually rebounded. Another thing that I would say is a lot of people right now are looking for a Fed pivot. You know, that's what you're hearing because the CPI was on the low side there at 7.7. So, the Fed's going to pivot. And then you see the Dow up, 1,200 points yesterday, the NASDAQ up, 5-6%, something like that. And I would just warn those people that if you go back and look at history, go back to the 1970s, every single time the Fed, quote unquote, pivoted, the market went down significantly. Even in the 1970s. So usually what happens is the Fed raises rate, but it's kind of like my good buddy Adam Taggart says, it's like the pig and the python, right? There's like this delayed effect where they spike rates up to, let's say, 4%, but you don't really see that play out in its entirety throughout the economy for maybe 6 months, 9 months, maybe even a year. So the Fed just keeps going up until they see inflation start to come back down, or maybe the unemployment rate go up. But at that time, the damage has been done. And then usually, even if they pause it as a result of the stock market coming down, if you look at that historically, the market still goes down by another 25-30%. Now, I'm just talking about stock. Now, I think we could see the same thing in the housing market as long as you're looking at real prices. I have a hard time believing that nominal prices are going to go down in the next 2 years by 20%. Now, they could, but I think they could go down maybe by 5% per annum. But then when you combine that with a potential spike in the inflation rate, like we saw in the 1947 by 20%, then you combine that 20% with the 5% compounded over 2 years. Now all of a sudden you're down, 35% in real term. And which, of course, is what matters to purchasing power. So I think that people should be very, very weary of, on the bullish side, as far as risk on, just because you think the Fed might pivot. Because the reason the Fed is pivoting is most likely something that's going to cause asset prices to come down very, very quickly. And they might even pivot because asset prices are coming down in a disorderly fashion, right? But I think that what that does is that brings on more fiscal, like we were saying before, because I think we've moved from that Fed put to a fiscal put, to a government put. And then that just takes us right back into the, let's say we get some disinflation down to 4 or 5%. That gives them political cover to come in with another CARES Act. And that's when I think they're going to try to issue a central bank digital currency and whatnot to issue the stimulus checks. And then I think it takes us into another wave like the 1940s of consumer price inflation. But this time, I think, especially if you listen to kind of the rumblings that we hear at the World Economic Forum, the UN, the IMF, a lot of these people, these global elite types, are talking about putting a cap on interest rates for central banks. So this Christina gal, I can never remember her last name, with the IMF. She's discussed this at great lengths. Now you have Stephanie Kelton actually talk about this, the MMT gal in the United States. And I think Janet Yellen is very sympathetic, I think, to Stephanie Kelton's views and the views of most of the people in the MMT crowd. And then you also had this gal, Rebecca Greenspan, come out, spelled different than Allen, but I don't know if they're related. But she's with the UN, and she was really echoing the exact same script that this Christina gal was echoing with the IMF, which is, okay, in the future, or they're saying maybe right now, we should have the central banks stop raising interest rates, because why should we look at the Phillips curve, and why should we try to bring inflation down by bringing unemployment up? That's not fair to the average Joe and Jane. So let's just have Jerome Powell stop, as an example, when we start to see an impact on the employment or on the unemployment rate. And then what we'll do, if inflation is still high, is we'll give people money to afford the higher prices. We'll call them inflation stimmies, ironically enough. And what we'll do is, because we understand that is going to increase aggregate demand, but we are professional economists. And remember, we are PhDs. So like Elizabeth Warren, we have a plan for that, right? I think what they'll do is they'll cap the central bank interest rates or interest rate hikes. They'll come out with stimmies to afford the higher prices, and then they'll do price controls, just like we saw in the 1940s and the 1970s, where they'll say, oh, all this inflation is just a result of these greedy capitalists and all these corporations, and they're just taking advantage of you and their windfall profits, yada, 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 yada. So we'll just go ahead and we'll solve inflation very, very quickly. We'll just make it illegal for the companies that are providing you with goods and services to raise their prices, and problem solved. So people have their free money, quote unquote. We've solved consumer price inflation, and we don't have interest rate high enough where it's impacting the unemployment rate. This is their argument, right? But we know what's going to happen with that is sooner or later something's going to break, and we know that if you artificially suppress the price of something, you decrease the supply. Yeah. So the supply goes way, way down, and pretty soon you've got to alleviate that pressure. So you got to get rid of the price controls. And when you do, you see the exact same thing we saw, like I said, in the mid-40s, where we had price controls after World War II up until about 1946. And when they lifted those price controls, that's the reason you had that massive spike up to 19.5% in 1947. So I know I'm kind of projecting far out into the future, but good. That's kind of my base case. That's how I kind of see this playing out when I look at the probabilities. That said, there are no certainties. Anything can happen. And I think as prudent investors, we just have to look at things in terms of probable outcomes, not certain outcomes.
Of course. If you enjoyed that video, you have to check out this one where Brent Johnson and George Gammon reveal what two critical things the market has awoken to in the last 12 months that you simply have to understand to not get blindsided in the coming weeks.